Hello again. This is Rich Vessel, founder of Advanced Projections, with our October 2022 economic report. So here's a review of the September economic data highlights. Employment figures for September came in with a still solid new jobs figure up 263,000, and unemployment moved back down to 3.5%. This now reconfirms what we have been predicting every month since our January 2022 report, that unemployment would dip to 3.3 to 3.5%. Unemployment should, however, eventually begin to gradually move upwards, and relatively soon. These low levels will still keep the Fed fully focused on inflation, as confirmed by Chairman Powell and other Fed governors. Annual inflation through September was announced on October 13th, with consensus expectations for it to be about 8.0%. The actual reported value was 8.2%, just below our own expected range of 8.3 to 8.8%. As oil and gasoline prices had stabilized, electric and gas utility costs have still risen dramatically and will likely continue to do so for the remainder of the year. Renewed production cuts by OPEC Plus will put a floor under any energy price declines for the time being. Equities markets gained a few percent in August, but gave back those gains in September, with further losses added in, setting a new low for 2022. With the inflation figures out on October 13th, equities traded frenetically, but resumed their downward trend. Our indicator system moved our recession risk level up from 85% to 90% last month due to continuing declining leading economic indicators, a very hawkish Federal Reserve monetary policy stance, and newly read AP FD indicator. There are now no indicators showing green and only one in yellow. Here's a quote from Thomas Barkin, president of the Federal Reserve Bank of Richmond, from July 2022. There is a path to getting inflation under control, but a recession could happen in the process. If one does, we need to keep it in perspective. No one canceled the business cycle. Elsewhere, we have written about how the National Bureau of Economic Research, the NBER, makes their recession starting and ending determinations, which come with recession declarations well after they have begun, by many months to over a year. So these declarations are helpful only in a historical or academic context. But for investors and business planners, they need to have a better system of recession leading indicators, and that would be our advanced projection system. Here are the current underlying economic details. Year-over-year consumer price index increases and supply chain issues have continued to plague many aspects of the economy. These have been keeping prices and inflation expectations elevated as demands for labor and materials remain above available supplies in many industries. In our June report, we said everyone should expect at least a few more months that are in the range of 8 to 9%. Per that projection, the June number came in hot and high at 9.1, and July was 8.5. General expectations out just ahead of the September announcement were for 8.0%, but it came in above that at an unacceptably high 8.2%, just below the range we were expecting. The Bureau of Labor Statistics employment and the Federal Reserve's intentions, unemployment remains well below 4%, over the past 8 months, now just 3.5%, with new job gains in September of 263,000. We expect those gains to continue, but dwindle for another few months in a restrained and declining fashion. There are still 10.1 million job openings being advertised for every unemployed person who is looking for work. That is well over 1.5 times the number of unemployed. The workforce declined a tiny fraction with a small monthly bump up not in the labor force number. The Table A, Summary Table A, that we always include in our report, shows the employment situation at the end of September with the general improvements in the employment picture we have been experiencing over the past 3 months and also compared to 1 year ago. The currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so, along with their 5 rate increases in the March to September timeframe and within their last available FOMC meeting minutes. Look for increased activity in these areas when the Fed returns with their next steps to be announced on November 2nd. We expect the November and December FOMC meetings to result in 2 more 75 basis point increases at a minimum. The FOMC's July meeting minutes and Chairman Powell's Jackson Hole speech last month confirmed that the Fed will be data-driven and resolute in their efforts to bring inflation back to 2% via a program composed of rate hikes and money supply contractions, also known as balance sheet reductions. Within the July 27th Fed FOMC interest rate hike explanations, we read a continuing expectation for another 75 basis point bump for this next rate increase. But with the new core CPI figure just out, it may be as high as 100 basis points and will be announced on November 2nd. There is a 6-week gap between the FOMC September and November meetings. We do not expect any delicacy or wavering on their part for the remainder of 2022. Third quarter 2022 corporate earnings expectations have been set lower by corporate finance departments. However, the number of companies who came in below expectations has increased above the normal proportions seen in these quarterly summations. Multiple retailers had already warned of a need for heavy discounting in the third quarter to clear accumulated seasonal inventories. In the second quarter, outside of the energy industry, all sectors reported declines in earnings growth. There's another chart and a quote by FactSet issued on September 9th, very clearly revealing what mainstream companies are expecting in the months ahead. These expectations were also confirmed at a recent investor conference sponsored by Goldman Sachs, but we expect third quarter growth to be 0 or negative as well. As third quarter 2022 reports come in during the remainder of October and into November, we expect to see our projected further earnings growth decline confirmed. The FactSet article quotation is, "We searched for the term recession in the conference call transcripts of all the S&P 500 companies that conducted earnings conference calls from June 15th through September 8th. Of these companies, 240 cited the term recession during their earnings calls for the second quarter, which is well above the 5-year average of 52. In fact, this is the highest number of S&P 500 companies citing recession on earnings calls going back to at least 2010, using the current index constituents going back in time. The previous record since 2010 was 212 companies, which occurred in the first quarter of 2020 at the start of the COVID-19 pandemic. By the way of comparison, 412 of the S&P 500 companies have cited inflation on the second quarter earnings calls, and 325 of the 500 companies have cited supply chain on quarter 2 earnings calls. The June, July, and September 75 basis point interest rate increases had already had a significant effect on the price of oil, driving it down more than 25% and hitting energy exploration equities hard as well. As we are facing further significant rate hikes, and clearly for other more political reasons, OPEC and Russia cooperated in an agreement to return to their 2 million barrel per day production cuts, which were enforced during the first quarter of this year. This is very likely to temporarily halt oil's continuing downward trend, which was looking like oil would potentially be back below $80 by the end of the third quarter. Depending upon political developments, these production cuts may create a plateau for oil prices between $85 and $95 per barrel for several months at least. This will, of course, add to inflationary pressures. Other major sources of energy, namely natural gas and electric power, have not declined at all in sympathy with oil. So those entities who do not rely on petroleum will be paying significantly higher utility bills for the remainder of the year. Natural gas prices may soon end their bit of a breather due to the fire at the Freeport, Texas export facility for liquefied natural gas when that facility returns to service in November. That will also keep electric power production costs high, as natural gas accounts for about 40% of the U.S. generation mix. Several new LNG facilities are under construction, and their export activities will keep upward pressure on natural gas prices and hence electricity as well. High natural gas prices have stimulated a renewal in well development, and there are now more drilling rigs in operation now than there were in late 2019. On the supply side for natural gas, the exploration industry is beginning to complete wells that were unfinished during 2020 and 2021 and will put them into production over the coming months. However, we expect high natural gas prices to persist as long as Putin tries to hold Europe hostage with restricted natural gas supplies, and as long as lower supplies and stored volumes persist domestically through the upcoming winter here and abroad. In equities, in July, the S&P 500 broke back upwards from its June low and closed the month of July around 4130, the same as it closed out April and May. That meant it was back solidly into bubble territory, and moves made between July 31st and August 12th put in another 140 points higher still. However, we also said that we expected resistance to set in around those levels based upon simple index chart reads. But a turnaround in market sentiment would depend heavily on some kind of negative news that would counteract the so-called good news from the very slight decrease in inflation for July, the cause for that most recent surge in equity prices. As we fully expected, inflation was reported to be alive and kicking on September 13th. So the counteractive news we were looking for materialized. The markets responded quite negatively, all major indices down in the 4 to 5% range within one day. By the end of September, new lows were set in all the major indices, with the S&P 500 down 25% for the year. Now we should continue to expect significant further declines in equities and bonds. A return from the current index level just below bubble territory to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 2900. In a typical bear market, negative investor emotions carry enough downward momentum to drive indices significantly below the mean, towards and through the inevitable retail investor emotions of despair and capitulation, when finally the selling ends. There is no current reason to expect anything different this time, as the Fed appears to be highly resolute in their attack on inflation, and that means more significant rate hikes are expected soon, beginning with the next one, which we just had on September 21st. They have clearly stated that their targets are, and as the quote we included from the FOMC's meeting indicates, they are dead set against pausing or quitting too early. There's a quote later on in the AP FD section in this report. We maintain an internally used chart called the S&P 500 EKG, and it is showing the classic signs of an incipient market heart attack, just as it did ahead of the Great Recession downturn. If this appearance in this chart continues, we'll publish the chart in an upcoming monthly report. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric, which appear ahead of real economic downturns. This, as shown in the chart in the report, is continuing evidence that something is seriously discouraging many risk takers from borrowing to finance equity speculation. And higher interest rates, of course, are only part of that equation. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.